Welcome back. Still watching Business Morning. The Securities and Exchange Commission has directed all existing investment crowdfunding portals and digital commodities investment platforms to note the requirements and eligibility criteria for raising funds through and or operating a crowdfunding portal and comply with the registration requirements or cease operations by the 30th of June 2021. The rules governing crowdfunding business in Nigeria came into effect on the 21st of January 2021, which was part of efforts by the Commission to ensure investor protection while encouraging innovation in the conduct of the securities business. To make sense of this, joining us now is Mr. Ayodeji Ebo, Head Retail Investment at Chapel Hill, Denham. Mr. Ebo, thank you for joining us this morning.
Good morning. Thanks for having me.
Great. So let's first understand the concept of crowdfunding in investment.
Okay, thank you. The crowdfunding, simply put, is trying to raise small amounts of money from a large pool of people. So typically is used for projects. Because of the hurdle of getting funding, whether equity or debt, for major projects, and also the size of some of the projects, most people across the world, you see businesses, non-governmental organizations use that to raise funds from little. So people come together, put their little money together based on the what I would say the value of what they feel they can part away with, and they are able to raise it from a large pool of people, and that's based on certain conditions or expected return.
Now, the SEC has directed crowdfunding platforms to comply with a June 30 deadline. Can we have a quick background of this guideline again?
Okay, thanks. I think the SEC noticed that if you look back in the last 4 years, there are a lot of crowdfunding platforms trying to raise funds for their project, especially within the agri space. In the last 4 years. So I think the SEC came up with the guidelines, because one of the major role of the SEC is to protect investors, especially the retail investors that may not have that leeway to be able to understand. They don't have much understanding about investment, and they don't also have that capacity to do their due diligence. So last year, the SEC released an exposure draft, which is expected that people will give their inputs. Stakeholders, Nigerians will provide their feedback based on the exposure draft. And following that, and based on what we heard from SEC, they were able to take a lot of feedback, and the final draft, or the approved draft, was released early this year, I think around January. And part of what was stated was that currently, because it's an industry that is already operating, so those that are already operating, some of the operational standard or guidelines or minimum operational standard have been set. So they've been given about 90 days for them to comply and restructure their businesses. So SEC is not saying to shut down, but in line with these regulations, because what typically happens is if there are no major regulations, you will see some dubious people trying to take advantage of that and setting up platforms that are similar, and at the end of the day may eventually also rub off on those that are even genuine. So what the circular now is saying is that the June 30th deadline will still stand, and they are expected that if you have not, you should have applied at least to the SEC, and the ongoing registration process should have been done. So I feel this is in order, and all those that are currently operating without the application or without registration, think to also give confidence even to their investors by the time they see that they are also registered with SEC.
All right, Mr. Ebo, do you see the SPACs trend coming to Nigeria anytime soon, and how will these guidelines actually affect the special purpose acquisition companies?
Yes, I think that there's already a rule. So what the SEC is saying is that for the small and medium scale enterprises. So for the small, you can raise about 50 million. Medium, you can raise about 70, and small, you can raise 70, and the medium, you can raise about 100 million. And you're expected to be in operations for about 2 years. And what that is basically saying is that at least before you begin to use other people's investment, or those that may not have that capacity to do a due diligence on your business, you would have run effectively for about 2 years. So for the SPV that you are talking about coming to Nigeria and coming to raise funds, I think part of what the rule is saying is you also need to register. So there's already a structure that has been put in place that gives independent party. You have from the issuer, you have the crowdfunding intermediaries, you have the investors, as well as the custodian, which is the bank. So I believe that once we operate, these companies operate within the confines of the rule, there will be no problem, and that would also help provide some form of confidence, because even there are a lot of funding that those platforms can attract, but a lot of Nigerians are still, or investors rather, are still skeptical in terms of the structure, in terms of the licenses that most of these platforms have.
Now, the guideline states that retail investors cannot invest more than 10% of their net salaries in crowdfunding activities. How do you think the SEC can implement this?
Very interesting question. I think that it will just be at the point of investment. Investors may need to just disclose what their annual salary is, and it's based on that they can be tracked. That it can be tracked based on the amount that you're investing. But if we also look at this, it may look, yes, it may be difficult to track, but looking at it from an investor's perspective, what SEC is also helping you to achieve is a bit of diversification. So don't invest more than 10% of your salary with one crowdfunding, with one firm or one fundraiser, if I put it that way. So it means you can look at different fundraisers and invest and spread your risk. This is what we call diversification, because if you are this form of this investment that most of them go into is high risk. Yes, there are insurance that are provided to also minimize the risk, and also be able to they are able to recover something in the event of a major disaster or a major breakdown. So I think that it may be very difficult for the SEC to track, because it's based on what you put inside what you state rather on the form when you are trying to subscribe. But also, investors should note that this is also to protect them, especially these rules that have been stated, like SEC said, is basically for retail investors that don't have the capacity to go to check the company, whether it's in Port Harcourt, whether it's in Abuja. They are trying to protect it so that you are coming to a platform that is being regulated and they can easily track. That would be like a check for the companies, those that are trying to raise the funds, and they will also be able to monitor the utilization of the funds.
All right, so can you talk us through who are the major participants in this market and their specific roles?
Okay, very interesting. Based on the rule, I think there are 4 major participants within this market or stakeholders. So starting with the fundraiser. The fundraiser is the company that requires the funds. What we have before is the company that requires the fund that also creates a platform to raise this fund, and they are also the one that warehouse the fund. So you can see that they control everything based on the current structure. Then with this new structure, apart from the fundraiser, you now have who you call the crowdfunding intermediaries, and they are also expected to be registered with the Securities and Exchange Commission. So this is like an intermediary between the fundraiser, then going to the third class of stakeholders, which is the investors. So they are the intermediary between the investors and the fundraiser. It is expected that the crowdfunding intermediary would have done some form of due diligence on the fundraiser before opening it up for the investors to put in their funds. So that will create some form of credibility, will create some form of assurance, and that would also help to attract more funds into that system. And the last one is the custodian, which we can also say the bank that warehouse that. So it means that you have 4 different parties, and that is what you call, there will be no conflict of interest, and there's delegation in terms of the controls are really very tight. So yeah, from the fundraiser to the crowdfunding intermediary, the custodian, as well as the investors, this would give some form of credibility and will be able to attract more funds to the program.
So how will this new guidelines shape the crowdfunding space?
Okay, thank you for this very valid question. I think that it's really going to add some form of confidence to the crowdfunding space. We've had a lot of defaults within, especially when we talk about the Agritech, a lot of default because some of these guys really are not experienced in terms of running a business. So some may not genuinely, the business might have gone bad, but what SEC, part of what they'll be asking them is, what's the risk management structure that you have on ground if this happens? So there will be a minimum operating standard. You have like an internal audit person that goes through the records, someone that you'll be able to keep accounts. There will be no commingling of funds. So I believe that is really going to add to the credibility of the crowdfunding space, and with the nature, especially the agri space that have been making use of this platform. Getting funding from the bank is always very challenging. But I believe that there's a pool of funds that they would attract once this structure is put in place, because it will reduce in terms of the default rates. And I believe that as we progress, even the amounts that has been capped based on the 50 million to 100 million may be reviewed as SEC sees how things are going and how they are expanding within that space.
So recently there was a story of investors losing about 2 billion naira to a fraudulent company that promised about 60% per annum. How can investors guard against this kind of scam?
Yeah, thank you. I think the first thing is that for the investor, you need to try to research into what you are trying to invest in. So when you look at the current instruments, available instruments in the economy, you would see that there's always a base. So you see treasury bills at 9.75% for 1 year. You see bonds at a maximum of about 14%. So that should give you an idea of what they can return. Yes, the type of business that they go into may generate higher return. But once you see, once it's getting above, when you are leaving the fixed income space, there's no return that is not guaranteed again. So even within the agri space that they promise guaranteed return, it should not be guaranteed. It's like a target return, because anything can happen within the process. So once anyone is giving you a guaranteed investment rather, even FX, you see people guaranteeing, giving you a guarantee for a return in FX, then you should run, because markets all these markets can be very volatile. And that is why you see for mutual funds, the fund manager will only give you the target return, because it is based on the available instruments that will determine the total return at the end of the day. So it's really important that once it's not a fixed income investment that you are buying the instrument, anyone promising you a guaranteed or a fixed amount, then I think you should question it, because what you should be promised is an expected return. Then you now understand the risk. But once it's also getting significantly high, and two times of what the treasury bills is doing per year, or the bonds is doing, then I think you should also be very careful. But if you even have to do it, then look at what we call value at risk. How much can you part with? So if this money doesn't come back, will it set you back significantly? So once you look at some of those, put in some of those situations or those scenarios, then I think that you will be covered. And that is why I would end with this. The SEC is also trying to protect the retail investors that don't have that capacity to do all this due diligence or understands how even investment works.
All right, Mr. Ebo, I guess the key word is, if I hear guaranteed profit, I run. Thank you so much for that advice. I guess we'll leave it there, Mr. Ebo. Thank you so much. Mr. Ebo, Ayodeji Ebo is the head retail investment, Chapel Hill Denham. Thank you for your time.